Hi everyone, Larry Bailey here bringing you another market update. Today is September 9th, 2024. We're going to be going through the week of September 2nd, 2024 in review. We had a lot of information happen, a lot of jobs data that showed the labor sector continues to slow down, while another appreciation report revealed that the national home values are still rising. Go figure. Here's the stories we're going to be going through today. Job creations revised lower again, part time workers rise. The next story is August saw the slowest and smallest private sector job gains since 2021. The next story is low hiring and quit rates show labor sector weakness. The next story is holiday impact on unemployment claims. And the last story of the day is home price gains continue. Now, if you're following along here on our podcast, head over to mortgage.community or the YouTube channel using @Mastering Encompass to see this entire replay and with video screen share on there. So let's get over to that next. Here we've got the first story with job creations revised lower again with part-time work rising. And we see this BLS report on screen. And so the Bureau of Labor Statistics reported that there were 142,000 jobs created in August, which was below the estimates of 160,000. Negative revisions to June and July shaved another 86,000 jobs from those months combined, which caused the unemployment rate to fall from 4.3 to 4.2%, but for all the wrong reasons that we're going to get into. What happened was there were signs of labor sector weakness throughout this report as the headline job number was well below estimates, while the year-to-date revisions have cut 365,000 jobs from the data. In addition, the number of part-time workers in August rose by 527,000, while full-time workers fell by 438,000. This actually means that the unemployment rate declined because the data counts people who are working part-time when they could not find full-time opportunities. The cooling consumer inflation that we've seen in recent months, combined with signs that the job market is slowing, have led to growing calls for the Fed to begin cutting their benchmark Fed funds rate, which, as a reminder, is the overnight rate for borrowing from banks from the Federal Reserve. This report was a crucial data point for the Fed ahead of their next meeting, which is happening very soon on September 18th, just about 9 days from now. And the week report keeps the Fed on track to cut rates at that time. How much of a cut we are going to see? A lot of people are thinking it's going to be 50 basis points. The conservative ones are thinking 25. The aggressive ones are thinking a full point. We'll have to wait and see. My personal money is on 50 basis points, and we'll kind of see how that goes. This next story is all about August seeing the smallest private sector job gain since 2021. And we see this ADP employment report on screen. We see this trend line for the monthly change in U.S. private employment, and we see a downward slope, which again is going to be very important for the Federal Reserve when they look at all of their data when they make their decisions on the 18th of September. So the ADP employment report showed that the private employers added just 99,000 new jobs in August versus the 145,000 that had been forecasted, marking the fifth straight month that job creation has slowed. Gains in education and health services, construction and leisure and hospitality were offset by losses seen in manufacturing, information, and professional and business services sectors. Small businesses also continue to struggle, as those with fewer than 50 employees lost 9,000 jobs in this period. This is compared to 110,000 new jobs added among medium and large companies combined. Bottom line in this story is Neela Richardson, who's the chief economist for ADP, noted that, quote, the job market's downward drift brought us to the slower than normal hiring after 2 years of outsized growth, close quote. She added that the next indicator to watch is wage growth, which is stabilizing after a dramatic post-pandemic slowdown, close quote. Next story is all about low hiring and quit rates show labor sector weakness. So this comes to us from the latest job openings and labor turnover survey, which is called JOLTS, in case you see that acronym. That showed that job openings fell to 7.7 million in July, well below the estimates, as June's report was also revised lower. The level of job openings continues to moderate and is down almost 13% from July of last year. The hiring rate, that rose to 3.5%, which is still near record lows set in 2013, not including, of course, the COVID period. The quit rate is also low at 2.1%, suggesting there is less poaching from other companies and fewer people feeling confident about finding new employment. So the bottom line here is we continue to see more weakness in the labor market with low hiring and a low number of people quitting their jobs. This was also reflected in the latest job cuts report from Challenger Gray and Christmas, which showed that hiring announcements fell to their lowest year-to-date level since Challenger began tracking this metric in 2005. Holiday impacts on unemployment claims, that happens about this time of year. So initial jobless claims fell by 5,000 in the latest week, with 227,000 people filing for unemployment benefits for the very first time. Continuing claims, they dropped by 22,000 as 1.838 million people are still receiving benefits after filing their initial claim. The bottom line here is while initial jobless claims fell to their lowest level since May, the measured week was just before the Labor Day, and this could have impacted the data as people often put off filing if they're traveling or busy for the holiday. Meanwhile, continuing claims have now topped 1.8 million since the start of June, remaining near some of the highest levels seen in recent years. This suggests people are collecting benefits for longer periods of time as the new job opportunities have become harder to find. The next story is home price gains continue. So ICE, which, by the way, ICE stands for Intercontinental Exchange. They're the same company that owns the New York Stock Exchange, among other things, including the Encompass platform. They have a lot of data metrics. They have servicing. It's a huge corporation. And so this data comes to ICE through the Black Knight acquisition. So ICE reported that the national home values rose 0.2% in July after seasonal adjustment, with their index showing that prices are 3.6% higher than a year ago, down from 4.1% in the previous report. So the bottom line for this story is ICE is not alone in their findings, of course, as home price gains continue to be reported in other major indexes like the Case-Shiller, CoreLogic, and the Federal Housing Finance Agency, also known as FHFA. These reports show that the housing still provides a great investment for wealth creation. All right, guys, football is back. Here's the family hack of the week. If you're interested in seeing this recipe for this spiced nuts, courtesy of the Taste of Home, as they make for a great game day snack, get over to watch the full video replay on either YouTube at Mastering Encompass or over at Mortgage.community. Both are free to watch, and right around this 7.5-minute mark, you'll see it on screen for the recipe there. So go ahead and check that out. Here's what we're looking for this week. The Fed will continue to be closely watching the crucial inflation data as it's delivered on Wednesday via the August's Consumer Price Index, CPI. The Producer Price Index, which measures wholesale inflation, follows on Thursday, and that's the PPI, along with the latest jobs claim data. That's happening this week. Also, what's important to note is that there are auctions. One is for the 10-year note, that's happening on Wednesday, and the other's for the 30-year bond on Thursday. These could move the markets. We see right now that the 10-year Treasury is around 3.7, and the 5.5% 30-year MBS coupon is about 101.31. Those are really impactful because when we look at the candlesticks that were happening here, we can see that the cost of money, so you can see this on screen, the cost of money continues to get better and better and better. And that just means that we're going to see improved mortgage rates as we go. You can see this trend line is just going higher and higher and higher. And that means that mortgage companies, banks, credit unions, companies that trade mortgage-backed securities are getting paid more for these, which also means that people are going to be refinancing. I bet you the people are challenging their current mortgage companies to lower their interest rates, or they'll go shopping. So keep that in mind if you are a borrower, and certainly keep that in mind if you're a mortgage professional. Again, my name is Larry Bailey. Thanks for always paying attention to what we're doing here in these market update reports each week, and we'll catch you on the next one. Take care.